this morning's hint of green is positive news because it shows that panic hasn't permeated throughout stock market investing. So that's really good news that it's toned down. But we're definitely not out of this. The news that you mentioned about restrictions in travel and companies not traveling to China, the suppression or the relaxation of the ability for people in China to get together, celebrate their New Year's holiday. All of this is going to bring down economic activity. It will impact GDP, it will impact earnings, and stocks, specific stocks, will definitely feel it, largely in the travel sector. You mentioned that earlier. We're going to look at restaurants, we're going to look at gaming, and we're going to look at hotels and airlines as sectors that are going to feel the brunt. But the overall market, especially here in the U.S., remains strong. So the fact that the futures are looking higher today says that we're not having as much panic as I feared, and that we're looking at this realistically and picking the areas that are going to get hurt the worst.
And so when you were talking about some of those specific groups, like the travel names, or maybe even focusing on the casinos, we know that was an area that was pretty hard hit. Is it big enough that it's going to take a material impact out of those companies' quarters, or is it just a little fear selling, a little profit taking on the possibility of this getting worse? I mean, is this a real material problem for these companies?
And that's the real question. And just this morning, I was looking at how long will this virus last, and is it a seasonal thing that can fade with the onset of warmer weather and more people outside? And frankly, I'm not enough of a medical expert to know, but that's going to be the question. If this is a few-month virus that people can contract, it's tragic, it's sad that people are they're dying and they're getting sick from it. But if we can, as investors, see that it's a several-month event and it's going to be more like the flu, where, hey, over 60,000 people die of the flu, and no one's wearing masks and no one's not going out because we've gotten used to it. We know that it's seasonal. We know that it can be somewhat treated and who it affects. If we can get the coronavirus, in our minds at least, to be perceived more like a very serious flu, then the panic subsides, and then these stocks don't have to hit the bottom like it looks like there's a little bit of panic now in some of the travel stocks.
And so, Mark, if you're an investor that maybe didn't pay super close attention to the market action while it was happening yesterday, but saw those big red arrows by the end of the day, with the Dow and the S&P down 1.6%, and you're getting ready to position yourself for today. Right now, indications are that we're going to open higher. What's your message to an investor?
My message today is the same as it was yesterday. If you're a trader, you might want to be active and listen to, again, the weaker sectors and not be making a position into those. But if you're a longer investor, I do think we just sit tight here. We don't want to panic sell. And look, if the green arrows continue today, that would be proven correct. I do think volatility is inevitable in 2020 with the valuations the way they are. Other unexpected events can happen. We're worried about earnings disappointments, how that could impact a market that's fully valued, if not overvalued. So I think we have to sit through some headlines, stick with our portfolios, and investors have to remember to build their risk allocations, their correct asset allocation before these events happen, because when they happen fast, and you don't want to be in reactive mode.